Welcome to this week's Focus of the Week, where we talk on economies, pensions, and real estate. On today's episode on Focus of the Week on retirement benefit schemes, we're joined today with Faith Ndunda from Pensions, who will be taking us through what exactly is happening in the market when it comes to RBS. Hi, Faith.
Hi.
So, I think one of the questions that has been asked coming up for this week has been, what are the main drivers behind the growth in AUM in Kenya's retirement benefit schemes, and how sustainable are these drivers in the long term?
Okay, so for the assets under management, or the AUM, for the pensions industry in Kenya in 2025 increased to 2.8 trillion, which was a 24.6 increase from the 2.3 trillion which was recorded in 2024. The main driver of this performance or the increase was majorly the implementation of the third phase of the NSSF Act of 2013, which began back in February 2025, and we saw the upper earnings limit increasing to 72,000 from 36,000, and the lower earnings limit increasing to 8,000 from 7,000. And the increase in contributions can also be seen in the total pension industry contributions, which also increased to 85 billion from to 35 billion in 2024. So the increase in contributions majorly increased the assets under management for the pensions industry. The stable macroeconomic environment back in 2025 also contributed greatly to the performance of the pensions industry, as we observed that the Kenyan shilling was fairly stable, as well as the inflation and other macroeconomic indicators, and this led to good performance for the investments asset categories. So majorly the macroeconomic environment and the increased contributions, specifically under the NSSF Tier 1 and Tier 2 structure.
So back to macroeconomic conditions. So how do conditions such as inflation, interest rates, and exchange rate stability affect pension fund performance?
So let me start with inflation. So inflation basically affects the purchasing power, and so if the inflation is high, it affects the real returns of an investment. So if the inflation is higher, say, than the returns that the pension schemes are offering, that means that the real return from that specific investment is diminished. And also going to interest rates, I will use the bonds in this case. So if the interest rates increase, we see that the yields on the new bonds that are issued also increases, but it affects the existing bonds by lowering their value. But if the interest rates reduce, say for instance the whole of 2025, we see that the existing bonds value increase while the yields for the new bonds decrease. When it comes to currency volatility, for offshore assets, when the Kenyan shilling appreciates, the return from the offshore assets reduces when converted back to Kenyan shilling. And also when the Kenyan shilling depreciates, the returns from the offshore assets increase in terms of in their value.
So you earlier mentioned about the increase in NSSF contribution limits aiding to the growth in AUM. But how do you think these phases will impact the retirement savings and formation of capital in Kenya?
So the increments in NSSF contributions to 6% of the employee's salary, which is also matched by the employer, is a good step towards retirement, since it's increasing the retirement savings when you compare it to the pre-NSSF Act of 2013, where we had contributions of just 200, which was matched by the employer. The current structure increases the savings for retirement, which basically increases the quality of life after retirement when we speak in terms of financial savings. And also in terms of investment, the increased contributions also increase the investable funds for the schemes. So you can see for the schemes, they can now diversify into other assets for investment, like infrastructure, and also participating in things like the public-private partnerships. So basically, economically speaking, it's a good thing where both the capital markets also grow because the schemes have more funds to invest.
And lastly, just to finish off, so with the decline in Q4 2025 returns for retirement schemes, so how should pension fund managers adjust their asset location and risk management strategies just going forward?
Okay, so for pension schemes, they're usually guided by something called an investment policy statement, which basically highlights how and the limits in various asset classes for a specific scheme. So if the returns earned by the scheme were not favorable, say in Q4 2025, the scheme can, through its trustees, can review the investment policy statement to a more favorable investment, which balances out the risk and return for the scheme. So also, generally speaking, the best strategy for pension schemes is generally diversification, because diversification ensures that the schemes balance out risk and returns. So say, for instance, if the equities returns are negative, they can be offset by, say, fixed income securities or even offshore investments. Also, the schemes can diversify into, say, fixed income assets to guarantee returns, and then they can balance out with, say, offshore assets and for return, and also invest in real estate investments to hedge against inflation. So basically, for schemes, it's just regularly looking at your portfolio and the returns from the various assets, and diversifying and rebalancing your portfolio based on the return and risk from the assets.
Thank you very much, Faith, for your insights on retirement benefit schemes. To learn more on the markets in Kenya, be sure to follow us across all our platforms on X, LinkedIn, TikTok, Instagram, and Facebook. I've been your host, Sharon Busuru.